given all the changes in interest rates of late and the fact that rates are going up higher and higher and higher, I thought we would take a look at a situation. So let's suppose that you financed a house basically almost 5 years ago. Well, approximately 5 years ago, you could get a 5-year mortgage rate of about 2.79%. And if that home was $650,000 purchase price and you put down 10%, by the time you add your CMHC fees, you would have financed $603,135. Now, with a 25-year amortization and a rate of 2.79, that would have had monthly payments of $27.89 per month. Now, let's flash forward and say you're here at today and your renewal is up and now you're wondering what to do given all the high interest rates, because the last thing you want to do is have your mortgage payments go up dramatically. Well, let's look at what you'd be facing. Right now, your mortgage balance would be $513,430. If you wanted to continue on paying down your mortgage at the same pace, in other words, have a 20-year amortization using today's rates of 4.99%, your payments would now go to $33.71. That's an increase of $581. Now, while it may sound like a lot, for a lot of people, their wages may have adjusted, other things may have come along, and that may be something they can absorb. $115, $20 extra per year on average over the 5 years, so that $581 may be something they can take. However, let's say that that's not what you wanted to do. What if we were to stretch your amortization back out to the 25-year mark once again? Well, if we were to do that, your payments would now be $29.83, which means effectively they would go up $193 a month over the next 5 years, which I'm sure for a lot of people is something they can sustain. It may not be desirable, but certainly not going to be the end of the world. Now, what if you said, look, I want to see virtually no change at all? Is that possible? Well, actually it is. We could potentially look at stretching the amortization out over 30 years. Now, again, that may not be ideal for what you want to do. However, that would bring your payments to $28.29, which means that the change is really $39.94 compared to what you've been paying. Now, I grant you, yes, you're adding an additional 10 more years onto your mortgage. That's never a thrilling option for folks, but if cash flow is what you're after, that's a good alternative. And the 25-year we just mentioned didn't have much of a change, so that may be a healthy compromise for both. Now, lastly, let's pretend, though, that you've amassed a whole bunch of debt for a variety of reasons, and now all of a sudden you've got, I don't know, hypothetically, let's say almost $90,000 in debt. What if we were to add that back into your mortgage? What kind of impact would that have? Well, if we take your original balance, your maturity, and add back the $89,000, you'd have a mortgage of about $603,000. Well, that would result in payments of about $33.24 per month if we stretched it out to a 30-year. That's an increase of $534 over what you're currently been paying. However, if you've got a whole bunch of different debts, I'm 99.9% sure they will total collectively higher than that as far as monthly cash flows. So, bottom line is, yes, rates are definitely up from where they were a few years back. However, it's not the end of the world. There's options out there that we can explore, options even that would allow your payments to virtually remain the same. Now, to see which one's the right fit for you, easy. Give our team a call at Auxilium. Auxilium simply means to care, aid, assist, and support. We do that here day in and day out, and we look forward to helping solve your situation.